Hello and welcome to a brand new episode of ET Markets Mark Talk, a show where we talk about market trends, investing yarn, as well as techniques on how to become an effective investor as well as a trader. Well, my name is Shadajan, and then today we have with us a very special guest, Dhananjay Sinha, who is MD and Chief Strategist at JM Financial Institutional Securities, and he has over 20 years of experience on D Street managing various roles. Welcome to the show, Dhananjay.
Thank you very much, Chitin. Yeah, nice to be on the show.
First question probably I wanted to put it across to you is that I'm sure a lot of investors or readers who are reading the interview as well as watching the show at this point in time, it has been a roller coaster ride for investors for the past 2 months. We've seen both local as well as global issues denting the sentiment on the street. So what are your views on that?
So the thing is that last year had been a fairly good year. There was a significant rally. And I think since the COVID, it has been a fantastic phase. I think what has happened since the beginning of the year, that there has been very high level of volatility. And, the year started with skepticism with respect to the buoyancy, the way, global factors are playing out. So I think the sentiments have been tested on both sides. So it's kind of a yo-yo ride, but it has actually been trending lower. So the thing is, what Indian markets are actually juggling with is the fact that there has been a consistent FII outflow that has been happening since September of last year. I think there is about $26 billion of outflow that has happened from Indian equities, whereas we saw that domestic players were still had a significant portion in the entire market. And there was good participation from mutual funds. So as a result of that, there was a sort of a tug of war that has been happening. But I think the macro picture is very important at this juncture. So the thing is that you have multiple things that are playing out simultaneously. One is the fact that you had a fairly robust commodity price rally, and because of the Ukraine-Russia war, it got further fueled. As a result of that, there is very high and persistent inflation across the world, across major economies and across emerging markets as well. And the kind of liquidity that was there fueling the asset price inflation since the COVID shock is actually being withdrawn. So there is a systemic sort of withdrawal of liquidity that's been there. So I think what is happening is that you have sort of a risk of a slowdown as far as economic growth is concerned. And also the fact that your liquidity, which determines your valuation, because it impacts the risk-free rates, etc., and the market risk premium, all those things are reversing. So you have a scenario where you have a risk on earnings. At the same time, you have a risk on valuation. And then the third part is essentially the market risk premium is also rising. So the point is, at this juncture, the market is actually debating whether we have reached a capitulation. Is there a valuation that is being created? Should we dip into the correction? And how should we construct a certain portfolio? So I think that is what the debate is at this juncture.
Rightly pointed out, Dhananjay, that's what the debate is. There's risk on earning, there's risk on valuation. And yes, people are looking at, should we buy this dip? Well, the biggest evil, which we've also come across, and it has been some time, but recently it got highlighted, and that is inflation. So what are your views on that, and how can one look at making an inflation-proof portfolio?
So the thing is that inflation was imminent. So the thing is, last year when the inflation started to rise, most central banks, which have the sort of mandate to control inflation, they thought it was all transient,
yes.
And starting with Federal Reserve and other central banks. In Indian, the RBI also thought, I think the beginning of the year, they were very dovish on inflation as well. So I think there was a certain sort of complacency on the part of central banks. They misread the trend in the inflation. I think the characteristic of this inflation is like this, that you have a significant demand source that had happened because of the stimulus that major governments had given across the world simultaneously across most countries and mostly in the advanced countries. And you had a significant rollout of liquidity as well that was also enhancing the demand side. And as you opened up, there was a sort of a surge in demand, especially for goods and stuff. And you had the labor market, which was getting very tight because you had given a lot of dole-outs, and also the labor force participation rate was not really coming up. And whereas the demand for commodities and goods were rising. So you had a scenario where the supply side was not really responding to the demand side because there was labor shortages, there were logistic issues, supply chain issues, disruption, etc. that was happening. And simultaneously, there was a significant rise on the demand side. So clearly, what's been happening is that there's a considerable amount of mismatch as far as demand and supply is concerned across goods, across labor market, etc. So it does look like sort of a persistent inflation. Mm-hmm. And at the same time, there has been speculative positioning as far as commodities concerned. So commodities have risen synchronously across the world, and that is also sort of creating another angle of inflation. So you have a very complicated and a persistent level of inflation that is there. So essentially what you're seeing now is that simultaneously now all central banks are embarking upon a tightening cycle. So US Fed is saying that you will continue to raise rates. They've already done 75 basis point hike. The neutral rate appears to be about 3.5%. So it can go further up, and it's happening in Europe as well. All these places, inflation levels are at 30-40 year high. So I think, and India also is embarking upon tightening. So there is a all-round tightening that is happening. So essentially, we'll have a withdrawal of the demand side because the supply side is not really responding as vigorously. Though there will be supply responses going forward. So, for instance, in agri commodities, for instance, because of the Ukraine-Russia thing, there is a shortfall of supply of food grains, especially wheat, corn, and edible oil, sunflower oil. So there is a sort of a synchronous rise in food inflation as well, which effects of which we are seeing in India as well. There will be supply responses subsequently, as in Europe and other places, farmers will increase their acreage and all. There will be supply responses. So the way I look at inflation trajectory going forward, there will be a sort of a slackening in demand as tightening of monetary policy happens. There will be a sort of drag of fiscal stimulus that was given last time. Now that thing is no more available. So there will be a slackening in demand there as well. And as a result of which the global growth will slow down, and there is a risk of recession also in major economies because of this sort of adjustment. As a result of that, there will be correction in commodity prices. There will be correction in demand for labor. So unemployment rate will start to rise. The mismatch on the demand and supply side of labor will also sort of come off along with the slower growth. So clearly, I mean, we are looking at a scenario where there will be a sort of a slower or a correction in commodity prices. We are already seeing that as far as steel is concerned, there is almost like a 20% decline there. Nickel is down 20%, copper is down 20-25%. I think steel is down even more. I think it's steeper. So I think some of those things are there. I think agri-commodity prices will also come off as we go into, that's the next one that will happen. And eventually the crude will also come off. So I think if you go into sequence of how commodity prices will sort of correct, it will be in sequences. So the way to really position ourselves as far as portfolio is concerned, we have to really sort of map this adjustment as it unfolds. So at this juncture, which are the sectors that can benefit from a potential sort of correction in commodity prices, especially in the context where the global growth is also going to slow. So you need to be in sectors that are resilient as far as demand is concerned. There are sectors that are actually gradually improving. For instance, in autos, there's a gradual improvement. Let's say commercial vehicle is gradually improving from a deep dive that happened post the COVID. So it's still emerging. A fall in steel prices, for instance, can be a beneficial thing for auto sector in particular. And then it will have an impact on other sectors as well. The government in India is also talking about has talked about imposing export duty on steel. As a result of that, there will be a significant correction in steel prices here. So I think it will have an impact on auto ancillary. Maybe as they also address the cement supply, there can be certain beneficial impact on construction sector, possibly infrastructure sector that depends on steel. So you can be selective, but I would say that within this also you need to understand that there will be a slowdown in India as well. And hence you have to really look at sectors that are resilient towards a slowdown. I think staple, for instance, is a clear example. So the second leg of correction that could happen is with respect to agri commodity prices. For instance, wheat has actually gone up. I guess in India, what can happen is that because they have actually said that there will be export ban on wheat, there can be a sort of surge in supply in the market. So wheat prices will correct. They have also talked about edible oil, the import of duty-free import of palm oil and all those things. So there can be certain sort of wheat, sugar. They are also talking about that. So if you look at it, wheat, sugar, and edible oil are three things that they are trying to tackle. So I think that should be beneficial for some of the staple companies, and staple companies will be generally less susceptible to a slowdown. So I think these are the two segments that looks to be very imminent at this juncture. I mean, there are other places where one can look at, but I would rather be somewhat conservative, because I think that the market has not really capitulated enough. So there is another capitulation that will happen, and that will be sort of relevant for deep cyclical sectors.
Right. So definitely autos is one thing. Autos, infra, cement, and staples are some of the sectors where investors can look at, or at least they are slightly shielded from the inflation shock. Is that right, Mr. Sinha?
So the thing is that inflation impacts everybody. So the thing is that we are at a very peak level of inflation. Right. What you have to really play is when officials across the world, central banks and governments are attacking inflation, you have to really play a contra call to that.
Right.
So basically, you have to anticipate that the commodity prices will fall. You have to anticipate that the inflation will come down. Let's say you're looking at 12 months' time or 24 months' time. Right. These are the things that will happen. So I'm not necessarily going into an inflation immune stocks.
More resilient.
I'm betting on a moderation in commodity price, and I'm betting on sort of slower growth and moderation in inflation as well, along with a slower growth. Yeah.
Right. And also in the past 2 months, or you could say 2 to 3 months since February, we have seen some bit of correction, obviously, with regards to the global events that have folded out. So any particular sector which has actually entered a value zone, according to you? Many sectors have corrected from the 52-week high. So any sector you think that has entered a value zone?
So the thing is that as far as value is concerned, I would say that if you look at the markets, you still need to have a de-rating. So generally the markets will still be correcting, because I think you are entering a new sort of phase, which is unlikely to be similar to what we saw in the last 7-8 years. So we are looking at valuations that existed prior to, let's say, 2013. So look at 2003 to 2013, and then look at where the stocks are. So and then look at the valuation, or a relative valuation. So I would say that there is a good amount of correction that appears to be happening. I think where potentially I would say the valuations are emerging, are in the space or beginning to emerge. I think if you look at the IT space, have actually come down. So IT index has come down very dramatically, almost like 30% sort of correction has happened. My sense is that if you look at another sort of 10% down, I think there should be value coming in. I would say, so that is where I'm trying to look at it, but I would still not go very gung-ho about it. I would look for better valuation. I would say that in the banking space, again, there is a steep correction in valuation that has happened. So the price to book has come down from 3.1 or something like that to 2.3 or 2.4 times price to book on a trading basis. I think it can still fall. I think people believe that there is value out there. Because in the context where you have sort of a dollar which will strengthen, rupee can weaken. I think while it is getting into a value zone, you still have certain amount of downside that is there. So that's another place I'm sort of very carefully watching. So these are the two spaces that I'm looking at. I think in terms of value and growth, I would say it is auto and I would say the staple names that staple sectors that I would look for at this juncture. Yeah.
Right. Any sector which you are underweight on at this point in time?
So I am underweight. I'm underweight metals, for instance. So I have been underweight metals for almost 6 months. So here, I think that it is more susceptible to sort of a correction in metal prices. We have already seen that in India there has been a fall in steel prices by almost like 25% from the peak of Ukraine crisis, and I think it can go down further. So we are looking at I'm looking at steel price coming down to almost like 35,000 per ton from currently about 50,000 per ton. It has already come down from 70,000 per ton. So I think there is a considerable downside that is still there. So I would say that is an underweight for me, and generally commodities underweight, because as I said, I'm really playing the contra call when central banks really attack and there is a slowdown, attack inflation, there is a slowdown and commodity prices correct. So that's an underweight for me. Secondly, I would say banking sector and the financial sector is an underweight for me because we think that as the commodity prices fall and what will happen is that your credit growth will actually moderate.
Yes.
Right now there is a recovery from last year. Last year it was 5.8% or something on a growth basis. You are somewhere around 10%. That's largely because there is a rise in interest rate and people are switching from money market to banks. So there is a sort of a switching that has happened, substitution, I would say. But I think it is also to do with the fact that commodity prices are rising. As we go forward, it will actually fall. So I think banks will struggle in a scenario where the deposit rates are rising and they will not be able to lend enough. And in the current context, I don't see capital goods really investments really happening. So private capex are unlikely to happen when such kind of scenario is there. So capital goods is another area where I'm sort of underweight. I'm hopeful of private capex happening. I think cement is one area also where I think when the government is looking at lower cement prices, they're trying to look at more availability and all. So I think the ability of the cement sector to really increase price in a context where the cost has risen, power cost, etc., logistics costs, etc. I think cement can also be susceptible to sort of a downgrade. So I think these are the sectors, from a cyclical standpoint, I'm sort of underweight.
Yeah. Right. And let's also focus some attention on the earnings front. We've seen March quarter earnings, and in that period of time, we have seen many global events play out. We've seen US Federal Reserve raising rates, as well as RBI also raising rates to a certain extent. We see commodity prices rising, and apart from that, I'm sure we have price shocks as well as demand shocks in the coming quarter. So how earnings will get impacted in, let's say, in the next quarter? So how should investors brace themselves for the next quarter of earnings?
So the thing is, what is going to happen is that, FY22, I think the Nifty earnings growth is roughly about 38%. So that's what the final number looks like, 38 to 40%. And that is largely on the back of the fact that you had a sort of a bad year in the previous year. So there is a statistical rise and an absolute rise in profits as well. So the EPS grew by that much. I would say the expectation going forward is also fairly robust. It's about 16-17% for FY23 and about 15% for FY24. My sense is that these things will actually get downgraded. So I am expecting that in general, there will be a significant downgrade of roughly about 20 to 15% as far as FY23 and FY24 earnings are concerned, because I do expect a slowdown to happen. Now, so essentially, if you look at the fourth quarter, it has been a reasonable quarter with about 20% growth. And you still had the benefit of a sort of a recovery, etc., that was there. You had Omicron in the first month and then it revived, etc. But what we are saying is that the real effect on margins, so the concern was largely on margins. There is certain mix of downgrades and there is certain mix of upgrade. There's on the margin, there is a modest upgrade of 0.5% or something like that, largely coming from the banking space because the bank sector actually wrote back on provisioning, and there is a sort of addition in the profit coming from that. So there's sort of skewed because of the banking sector numbers, but generally there is emergence of margin pressure because of high commodity prices that has been there. I think going forward, you will see margin pressure emerging. So I think more intensely over the next 2 quarters. So because with the lag, people may have actually bought into contracts for inputs, etc., which at peak level. So I think in the next couple of quarters, you might actually see sort of a contraction in margins, and that will translate into downgrades as far as earnings are concerned. Subsequently, I would say as we move into the second half, by that time, I think we will see commodity price correction. So what will happen is that time you will have a sort of an issue with respect to top line growth. So top line growth will start moderating significantly because there will be a commodity price deflation or correction that would happen. And possibly it will be relevant for the following year as well. So I think you are looking at a sort of a downgrade in earnings in the next 1.5 years. As I just said, that we are looking at a sort of a 15 to 20% downgrade for FY23 and FY24. So I think that is what it is. I think the way to really look at is which are the segments that can actually outperform. So this is a general direction, but you have to really look at which are the sectors that can outperform. There will be sectors that will benefit, and there will be sectors that will not be benefiting. So generally, I would say that commodity intensive sectors, which are very susceptible to top line growth, and there's a correlation with respect to commodity prices, those are the sectors that will suffer because their top line growth will come down. And since during that time, they will also suffer with respect to the margins, etc., because top line growth will funnel into the margins. So while in general, there can be an improvement in margins, but it will not funnel into a significant robust profit growth. So essentially, then we have to really look at sort of a more sectors that are resilient, top line growth is resilient, benefit companies who benefit from lower input costs, etc. You have to really look at those segments. So clearly, I would say it's largely going to be a domestic consumption-driven cycle. Possibly at that point of time, at some point of time, the pressure on the IT space will also come off because as there is a slowdown in US geography, etc., there will be a sort of I think I'm expecting a structural sort of a commitment towards technology by US companies and developed market countries because they are facing very high labor costs as well, and there are transformation as far as supply chain is concerned, which also requires a certain investment. So I think at some point of time, while the correction is happening, eventually India will continue to see reasonable traction as far as IT spending by US and companies are concerned. So it might come at some point of time. And I think after that, I think it should do well. Yeah.
Right. So I think one thing which investors should praise for at this point in time is likely earnings cut. And do you think that some of it is already getting discounted in current prices, that the street is also anticipating earnings cut in the next few quarters? Do you think that it is getting discounted at this point in time as well?
Yes. So as I said, two things. One is the earnings cut and the other thing is the valuations corrected. Right. So I think the valuations have corrected. So if you look at the on a trailing basis, the Nifty valuation has come down. I mean, at the peak, it was 40. So that was more statistical. I think from something like 28 times, we are at something like 19 times or something on a trailing basis. 19, I would say 19 to 20 times. What I'm looking at is something like 18 times on a steady state basis. So you still have a downside to go, and possibly it will breach 18 times as well, because when the market corrects and capitulates, there is a furthermore correction than the average that one can look at. So I think downgrades can happen. So you have earnings that can come down. So I think a large part of valuation downgrade has possibly happened, but it can still happen, which I'm not really ruling that out.
No, absolutely.
So I think that's how I look at it. Yeah.
In fact, my second, in my last question is actually linked to this question, and that is, what would be your advice to the new age investors, especially the ones who have just started investing, let's say in 2020? Now, this is probably the first time when they are seeing a double-digit kind of a drawdown. So, any advice to them? Because we've seen that we've in fact branding them as new age investors, and they've come of age, and they are more resilient to the drawdowns. But we saw some bit of in the mutual fund data, we saw some bit of retail investors declining their SIP flows. So SIP flows have sort of come down. Do you think that's the indication that
yes,
the more resilient retail investors, which we thought that they've come of age, might not have come of age? So what are your views on that as well?
So Kshitij, this story keeps on repeating. I think I see in 2017, if you recall, and 16 and 17, when you had the demonetization and GST shocks, you had large amount of liquidity that was there in the system, and the mutual fund flows increased from something like an average of 5,000 per month to almost like 20,000 per month around October, November 2017. And what it did was to really create a sort of a bubble valuation for mid and small cap, because these guys, so last time they invested through the mutual funds. This time they have actually invested directly. And lately, I think the remaining part, the guys who actually thought they were left out, they started investing through mutual funds. So essentially, what you have seen, so if you look at 2017, 2018 was a washout. All the mid cap and small cap went down by almost like 70%, 60%. And if you look at that point, in 2017, people were saying that, retail participation in structural, there is financialization of savings that has happened. You don't care about what FIs do. I mean, that was the story that time. So I wrote, I think somewhere in October of 2017, that this is a misnomer. If you look at last 30 years, retail participation is a function of how the markets behave. So if the market is doing well, it pulls in more retail investors. And as it does bad, it is a vicious cycle on the downside. So it did happen in 2018. So if you look at the average flow into mutual funds came down from 20,000 to 8,000. So there was almost like a 60% decline in 2017. If you look at the recent cycle, again, the same thing. This time, retail investors directly done that. More recently, through mutual funds, you had a large liquidity that RBI had printed through reduction in rates and the TLTRO, other things, a lot of other things that RBI did. The LAF balance in the banking system went up to almost like 8 lakh crores, 8.5 lakh crores, almost like 5% of the banking deposit. And large part, significant portion of that came into the banking, into the stock markets as well, initially through direct investments and more lately through mutual funds. So again, there is a bubble in the mid and small cap. As the liquidity tightens, there will be a major capitulation. So I've been warning people not to be there and move and to get out of that zone. I've been saying this for almost like 6-7 months now. It is actually capitulating. So you see the mutual fund flows actually decreasing, which means you will see significant risk in valuation for small and mid cap names. So my advice to the new age investors is to really wait rather than catch a falling knife. There is what they need to really look at last 15, 16, or almost like 20 years data performance of various companies. Look at continuous compounders. There are so many continuous compounders for the last 20 years. Then you will have a capitulation. You will have those stocks which will be available at very good value. Because if you start investing in those value, you will actually make a lot of money over time. So you need to really wait. Don't be in a hurry. There is a sort of value that will be created. It is not an overnight thing. You need to time it well. You need to look at right value. You need to look at sustainable business. I mean, you can do a lot of study on that. Basically, in nutshell, apart from these continuous compounders, you need also look at companies who have actually shown continuous increase in return ratios, even in stress times after 2014, the slowdown that has happened. there are sort of companies actually shown increase in return ratios. Those will also sort of create value as the capitulation happens. So I think not to hurry really, and not to get into mid and small cap. You would not expect return to happen very quickly. So don't be in a hurry.
Don't be in a hurry.
And don't be reckless.
Right.
Don't be reckless. Don't burn your money.
Absolutely golden words coming from Dhananjay. Don't be in a hurry, don't be reckless, and wait it out. Look at 15, 20 years of data of continuous compounders. There are many stocks out there, but yes, wait it out. That's the word of caution coming from Dhananjay. Well, on that note, thank you so much for your time today, and that's all for now. But do stay log on to etmarkets.com for more on news, business, and economy. Thank you so much for your time, sir.
Thank you, Shadwi.